Welcome to Sand Compounding. Today's session will analyze what profitability means and how to analyze the profitability of a company. Profitability is a very important factor when we analyze a company, and it just indicates how profitable the company is, to put it in a very layman term. Let's analyze and see how. So all measures leads to different ratios called return ratios, and this way we are measuring how much earnings the company is generating for every dollar of sales or every dollar of capital employed. Profitability forms a significant factor in the calculation of return ratios, both in terms of return on equity and return on invested capital. This, to quote Warren Buffett, where he mentioned, our preference would be to reach our goal by directly owning a diversified group of businesses that generate cash and consistently earn above average returns on capital. Now, what Warren Buffett indicated and propagated was more on returns on capital in terms of return on equity, but in return on invested capital is also a significant return ratio. All return ratios follows a simple measure of profit over a measure of investments as a relative measure, and we had already seen in the earlier sessions, right? I mean, what gross profit, operating profit, and net profit margins are and how they are calculated. Why I'm bringing that margin factor is because profit margins is one part of the profitability calculations. There are different ways to do profitability analysis. Profitability analysis includes the trend of all the margins like gross, operating, and net over the years since the firm is listed, and also it entails comparative study with similar businesses or in the similar industry within the same country. Primarily, we need to look at gross margin analysis and operational expense management as part of this. So those are the two main factors which are subsumed in as part of the profitability analysis. Let's understand what gross profit margin analysis means. So it includes analyzing how the gross profits gets impacted. It could be primarily gross profits. Just to recalibrate the conversation we had earlier, gross profits are nothing but the total sales or revenue and subtract the cost of goods and services. Now there are two factors and the difference gives you the gross profit. So what can influence the gross profits? It could be either the sales, which is impacted by the pricing, or it could be the expenses, which is the cost of goods and services. Now pricing is where the competitive advantages plays a big role. Now, as Buffett and Berkshire Hathaway, we know where has brought in this concept of moat or monopolistic economic advantages that companies has, which could set the pricing and has a pricing power. Now further, the pricing strength of the business exists when they have the power to increase prices or pass on the price increase in the cost or expenses. Now impact on gross margins could be due to the increase in the price or increase in the revenue by volumes. Both can impact the gross profit. And another impact on gross profits can be due to increase in the cost of goods due to either raw material cost, because manufacturing or the cost of goods includes the raw material cost. When raw material cost increases, the cost of goods increases and the manufacturing cost increases. Many firms can procure low cost materials from other countries or can source low cost labor from low scale economic zones or even outsource manufacturing to increase their margin. So these are all associated with the cost of goods and services. So there are two parts to it. Some firms can bring in even premiumization of products with fashion, for example, upscaling into higher fashion trends, brand endorsements with celebrities, migration to the top of the value chain products in, say, retail or fast moving goods, and even though newer products, newer services, and newer markets can increase sales for a firm. So there are different ways in increasing sales, and there are different strategies associated with each of the sessions that we are speaking about, and they themselves are different topics which we find and analyze in detail on later sessions. And so overall there are many ways firms innovate and maintain or increase their gross margins. The other part to it is the expense management, primarily from the operational standpoint. Now, all operational expenses other than the cost of goods and manufacturing can be controlled to improve profitability. So earlier in previous slide, we saw how the gross profits and gross margins can be improved, or the cost of goods and services can be reduced to achieve higher gross margins. Here we are talking about the operational side and associated with maintenance part of it. So all operational expenses includes like wages that is given to employees, utilities, like the power and things, and then the marketing, sales, research and development, and other many administrative items typically involved in running an operation of a business. There should always be calibrated reduction in sales, marketing, HR, research and development expenses, and even reducing these expenses can impact long-term product pipeline or growth. Even it could end up losing market share. So it has to be a very calibrated approach when a firm involves in expense management, especially on the operational side. Primarily, they can impact when you reduce too much on the advertising, marketing, or reducing the sales force, and the research and development expenses. These three should be very cautiously and meticulously reduced or controlled. Overall, maintaining a tight control on the operational expenses can yield higher margins and hence higher profitability. So hope this session was useful.